voice on that. Ruchir Sharma, who's the emerging market head at Morgan Stanley Investment Management, doesn't see a bull run anytime soon for the Indian markets. He feels that India is not spectacularly better compared to other emerging markets and that market expectations have become realistic here, is what Ruchir Sharma is saying in an exclusive chat with ET Now's Nikunj. Dalmia.
There's still many negatives on the ground, but the main reason which has made me a bit more optimistic in the last 6 months is that expectations have changed. Gone is this nonsensical talk which I used to hear last year, that India is bound to grow at 8 to 9% and nothing matters, that's India's destiny and demographics is destiny and politics does not matter and they can keep spending away. Those are all minor things to do. For every good sort of thing which is happening, like the currency is very cheap and competitive, which is good. You have state leaders who are more competent that are emerging, which is good. You have negatives also as far as India is concerned, which is that the perceptions on corruption have deteriorated massively. There is still no sign that government spending is going to be controlled. So you want some reversals on that to take place and to stick.
What about your current portfolio strategy for someone who manages $40 billion a year ago, was neutral on India? This year, are you hot on India?
Well, we've gone overweight for a couple of reasons. One, expectations have changed. And to me, the other sort of thing about India which I find good is the fact that the currency is quite cheap and competitive. And the third reason is commodity prices.
Indian equity markets have been quite resilient this year. In fact, we are up 20% and we've got record inflows of about $20 billion. What explains this phenomenon?
Well, I think that two factors. One, that most emerging markets this year have delivered double-digit returns. The big ones have not, but many sort of other markets have. So the average emerging market is up more than 10% anyway. So India has done well, but it's not as if India has done spectacularly well relative to other emerging markets. The second factor is that we're catching up. That last year we were at the bottom of the pile. So in terms of our relative performance. This year we are catching up for some very bad performance last year.
What drives the market are three factors. Global liquidity, which is plenty. Second, sentiment, which is changing. And third is earnings. So what are your thoughts on earnings for India?
I think as far as earnings are concerned for India, I think that it'll grow in line with nominal GDP, and nominal GDP in India is growing, currently if inflation settles at 7-8% and growth at about 6% or so, I think that can translate into earnings growth in India.
On a scale of 1 to 10, looking at the way how global macro has evolved and how local macro has changed, do you think Indian markets have a firm bottom in place and something dire has to happen for benchmark indices to crack by more than 15-20%?
Yeah, I think so. In terms of that, you really need some massive local failure to take place out here, or you need some crash internationally to happen. But as I said, that let's not forget, we're coming from a very lean spell. The market today in dollar or inflation adjusted terms is still 30% below where it was at the 2007 peak. So there is room for catch up. Now, there is upside potential because we're still well below our all-time highs out there. But to expect that we're going to have a rip-roaring 2003 to 2007 bull market, I think that we are still some way away from that.